All right, so you should be able to see me, and I'm actually, let me see, hopefully with videos and such, you can still see the slide. Maybe turn off the view of the video, and maybe I'll turn my video off too, and then just come back on at the end, because I think that might, because sometimes the video in the upper corner will block the slides. So let me do that. Okay. As I said, and Tammy, I still see your video on too. Perfect. All right. Perfect. All right. There we go. So that's a little bit about my backstory. And I am always available for a free 30-minute call. I'll show you how to do that at the end of the presentation. So let's talk a little bit about notes, because you hear, what are notes? Notes are basically just a promise to pay. They're a debt instrument, everybody. That's all it is. And when you invest in notes, you literally become someone's bank, right? So one of the beautiful things about a note investing is that it's not like having a property where you're a tenant, where you have tenants, right? Because as wonderful as that is, it can be a headache to be that landlord, right? When the air conditioning breaks or the toilet is overflowing at midnight, they call you or your management company. In the note investing space, because you literally step into the shoes of the bank, they don't call you. They call the AC repair guy if the air conditioning breaks. So, right? So notes are basically, again, just a debt instrument. They're a promise to pay. And yes, you really do become the bank when you invest in notes. You step into the shoes of the lender. So call me Mrs. Chase, all right? Now, there are different types of notes that you can buy. There are secured notes. There are unsecured notes. Secured notes are pretty obvious. There's collateral securing the promise to pay. And in real estate, that collateral is the house or the commercial building, whichever, whatever investment vehicle you use, whatever is in your buy box. Some note investors will buy nothing but commercial notes. Some investors will buy nothing but residential notes, etc. So there are secured and unsecured. Unsecured is typically like credit card debt, right? So every time you sign that PIN pad, you're promising to pay the bank back for the money that they're fronting to buy that object, whatever you're buying, okay? And that's an unsecured debt. Auto loans are another form of secured collateral, secured note investing, right? So there's many different kinds of notes that you can buy and different types of notes out there. Now, there are also performing notes, which means that the borrower is paying that monthly payment as is their obligation. There are also non-performing notes. Non-performing notes means the borrower has stopped paying, okay? Now you say to me, because my focus, and anybody who knows me or who has heard me speak before, everybody knows that I focus on first position, which means I'm the first in line to get paid, non-performing notes secured by real estate. So I buy the debt in the first position, and the house is my security. That's my collateral. Now, it sounds counterintuitive, right? Because I'm the cash flow chick. I want to make money. So it sounds very counterintuitive. Why on earth would I buy a non-performing note? Well, I buy them because I build in a very deep discount based off of the securing collateral. And I don't base it off of whatever the unpaid balance is. We're going to talk about that in a little bit. I buy that note at a discounted rate off of the current market value of the securing collateral. So we take the current market value of the house, and then we discount that note from there, okay? So when I do that, I actually build in a cushion of equity. So I am not as reliant on market conditions as someone who is perhaps in fix and flip, right? So So that's why I typically invest in non-performing notes because, oops, I'm sorry. I was moving the chat box over because I can mitigate my risk by buying at a discount. All right. Okay. Is there competition in note investing? Yes, there is definitely competition in note investing. Like anything else, you know, people look for avenues to make money. It is what I call a gentler form of competition. Any of my students can attest to the fact that when you get hooked up with an asset manager, they literally tapes come to your inbox. So I don't have to, yes, there is competition, but it is a very gentle form of competition. And with what we've
She
seen
was like, can I just say something? I'm like, yeah. And she
was that, did somebody have a question? Sorry. Okay. I guess not. All right. And everybody, I'll come back to your questions in the chat box after for the Q&A. All right. Okay. So competition is definitely a lot gentler. And we've seen a lot of craziness, especially over the course of the last couple of years. And we are seeing, of course, that the market has slowed. I did a recent market conditions and it's very interesting. Even in the note space, the deals have been a little overpriced because of the market. But all of that is changing. And those of us that are in the note space have been preparing for this wave that is coming over the next, what I predict. Now, again, I'm not, I'm not an economist. I'm not a fortune teller. But I do predict that there's going to be some massive opportunities that are coming, and we're starting to finally see that right now. All right. So that being said, how do I find deals? I do not knock on doors. I do not send out yellow letters. I do not pick up the phone and make cold calls. I don't do any of that stuff. I don't do bandit signs, none of that stuff. I build relationships with asset managers. And how I do that is by going to conferences and reaching out via social media in various platforms. There are several of them that are out there. And develop relationships. So I develop relationships with asset managers, and they literally send their product that they have for sale, AKA their notes that they have for sale, to my email inbox, right? So as such, I can literally do this business anywhere in the world as long as I have a phone and a computer. I am not tied to a specific location. So I can literally be doing this business sitting on a beach in some far off land if I want to, right? All right. So it affords me a lot of flexibility. Now let's talk about exit strategies. I talked about this a little bit, but let's briefly go over this. All right. So, and then I will break this down in the next slide. I will break this down how this applies to note investors. So unpaid principal balance, that is the face value of the loan. So it is literally just the principal portion of the amount of money that your borrower owes to you. So we're going to use some examples here. In this example, our unpaid principal balance is $100,000. And those of us that are in California and even Texas nowadays, especially, right? $100,000 loan is a little difficult. However, there are many states across this country where you can buy a house for $100,000, right? All right, so we're going to use this because it's also easy math. So unpaid principal balance, that's just the principal balance. Now remember, I buy non-performing notes, so they have stopped paying. And as such, there's extra fees. Those fees that are added in are default interest. Any taxes that I may have paid on behalf of the borrower is a recoverable expense. And all of the late fees, property preservation, forced placed insurance, and I don't have time to talk about all that stuff right now. But all of that rolls into what we call the legal collectible balance. All right. And in this example, our legal collectible balance on this note is $120,000. Now, lately, we have not seen this, but this is coming, everybody. We're already starting to see the reduction in home prices as we're cooling. Now, it's been slow, but that, I think, is going to be changing over the course when we start to hit 2023. All right. So current market value of the securing collateral, which is the house, on this example is $80,000. So this borrower is $40,000 underwater, right? They cannot sell their house for the full amount of money that they owe me as the bank. Remember, I'm Mrs. Chase. So I buy my note. I'm going to buy this note not based off of the 100,000, not based off of the 120,000, even though that's the full amount of money that's owed to me. I'm going to base my purchase price off of the current market value of $80,000, and I'm going to discount it from there. Now, when I started note investing, I was able to buy notes at a roughly 36, sometimes a little less, but roughly 36 to 42 cents on the dollar. That's when I started. Now, those that preceded me were able to buy them at 18 and 20 cents. Now, I don't think we're going to get back down to those levels. However, I do think we are going to start seeing some very reasonable levels. For this example, and lately it's been pretty high, 62, 65, 70 cents for non-performing notes. It's starting to come down. So in this example, we're going to say our note purchase price, just for easy math, is 50% of the current market value of the securing collateral. So I'm going to buy this note for $40,000, even though I'm owed $120,000. Now, much like fixing and flipping, we have workout costs, rehab costs for this paper, right? Our workout costs, again, depending upon judicial versus non-judicial states, is going to vary. For this example, we're going to pretend it's a non-judicial foreclosure state, and we're going to use easy math, $5,000, all right? So I'm into this note for $45,000, which automatically builds in equity of $35,000, because the current market value as the house sits right now, not ARV, not after repair value, but as the house sits right now, is $80,000, all right? So even if there's a dip in the market, I'm still okay because I've built in that cushion of equity already, all right? Now, let's take a look at those exit strategies. We have 23 different exit strategies in note investing, which helps us to mitigate our risk, which means no matter what the economy does, no matter what the market conditions do, we have the opportunity to pivot. When we are able to do that and willing to do that, we can mitigate almost all of our risk in note investing, okay? Now, we don't use all 23 all the time. We typically only use 4, and I'm going to talk about those right now. Our first one is foreclosure. Most of us know what foreclosure is. We have across this country, about 50% of the country is judicial, 50% is non-judicial. Foreclosure in the states that I invest in, and I avoid states that have exponentially long foreclosure times, like New York. It's 4 years to foreclose in New York, right? So I avoid states like that. Typically the states that I invest in, judicial versus non-judicial, the non-judicial, it's about 6 months to get through a foreclosure process. In a judicial foreclosure state, depending upon the state, it's going to take you anywhere between 8 and 16 months. It used to be 8 and 12 months, but things with COVID have extended that period a little bit, all right? So in our example, and judicial is my least favorite, by the way. I don't like judicial. Foreclosure is my least favorite, by the way. I don't typically like to, that's my last exit strategy. That's my least preferred. I prefer to work with my borrower and to get them to reperform. We're going to talk about that in a second here. But if I have to go to foreclosure, then I'm going to take it, through that process. And let's say we have a house that's a little bit beat up, right? And even though we know it's worth $80,000, we start the foreclosure we start our opening bid, and we get to do that as the bank. We start our opening bid at $70,000 and it sells to a third party. Well, at the end of that foreclosure, that third party that bought it is going to get the house, and I'm going to get $70,000, right? Or $80,000. Most of the time you don't get more than what the current market value is. So that's why we base our price and discount from the current market value, not the ARV. All right. All right. So if this is a non-judicial foreclosure state, I've now made $25,000 for just flipping the paper. Okay. I did not pick up a hammer. I did not have to rely on contractors, none of that. Right. So hopefully some light bulbs are starting to go off for you. All right, our next is short sale. Now, I think that we're going to start seeing, especially in 2024, because of all the high prices that have happened in 21 and 22. I think we're going to start seeing another round of short sales because people paid they were outbidding people by hundreds of thousands of dollars, especially in California markets, right? Now, a short sale is basically with that $120,000, I, as the bank, am willing to take a lesser amount than I am owed, right? Generally, a short sale takes 3 to 6 months. Now, what if I sell this house to a neighbor that wants to buy it for their kids? And even though the current market value is $80,000, value is in the eye of the beholder, everybody. What if that neighbor comes to us and says, I'm willing to pay you $90,000 for that house? How fast do you think I'm going to say yes? Because I know that I'm never going to see the $120,000 that I'm owed, but I'm going to use that as leverage, right? I'm going to use it as leverage to either get my borrower to reperform or to have another outcome and a short exit on this note. All right. All right. Deed in lieu of foreclosure. Deed in lieu of foreclosure is when our borrower comes to us and says, I don't want this property anymore, but I don't want you to foreclose on me, Mrs. Chase. I am willing to sign the deed over to you as payment in full for my loan. All right. So I, as Mrs. Chase, have the option to say yes or no to a deed in lieu of foreclosure. And there are some pitfalls, everybody. I can't talk about it right now, but there are a couple little pitfalls, right? But generally this takes about 3 to 6 months, this process. I have many different options if I take it as a deed in lieu of foreclosure, which means I take possession of the actual house, right? I don't now just own the debt goes away, I now own the house. I can sell it as an REO, right? Real estate owned for $80,000 or $70,000 or $90,000. I can fix and flip it myself. I can turn it into a short-term rental. I can turn it into a long-term rental, right? A buy and hold property. So there are many different things that you can do as the bank, and you never lose control over this whole process. All right. Now, my favorite is what I call reperforming. Not just myself, the note industry knows it as reperforming loans. Reperforming loans generally are a little bit longer. They take generally 6 to 12 months, depending upon who you are as an investor. Now, this is where I'm going to use that $120,000 that I'm owed and leverage it to work with my borrower to motivate them to start reperforming and start paying. A lot of borrowers, because when they fall behind everybody, life just happens to people. It doesn't make them bad people. It just means life happened to them, right? So I can use that 120 and maybe forgive some debt. I don't have to forgive all of it, but use it because I'm never going to see it anyway, right? So maybe $20,000. And we are going to set a new UPB, unpaid principal balance, at $100,000. We can reduce interest rates. We can extend the life of the loan. Now, keep in mind, everybody, that again, value is in the eye of the beholder. But this is the perfect strategy to also have a little skin in the game, right? We can require the borrower to put up a little chunk of cash up front during a tribal payment plan, I use a forbearance agreement first for a short period of time, and then we permanently modify it once they prove themselves that they can do it, right? So we're now literally refining that loan, everybody, which starts the clock all over again. And as note investors, we make our money in interest. Now, interest, the primary, when you reset a loan, especially when you're paying that, receiving that monthly principal and interest payment from your borrower, most of it, 95% of it is interest for the first 5 to 7 years. Now, most borrowers, once they get back on their feet, most people either sell their house and pay you off in full, in which case, if we have reset our loan for $100,000, we have the option, you know, that our borrower, we could hold on to it for a period of years. We could sell it to another note investor, right, for a small discount. And if I'm into this note for $45,000 and I turn around and sell it after 12 months to a performing note investor, let's say I sell it to them for our unpaid principal balance is 100,000. Let's say if I sell it to them for 90,000 and I've required a $2,000 deposit and I've cash flowed $600 a month for 12 months, right? Do the math, you guys. And we create a win-win situation. I'm giving people a second chance to stay in their home. All right. All right. Now, how important is due diligence? Extremely important, right? I always like to say, if something doesn't appear right, it probably isn't. So there's an extreme amount of due diligence that needs to be done in note investing. Again, I don't have time to talk about that, but I do teach on it, and we'll talk about that in a little bit. But I like to say that good due diligence will give you virtually risk-free note investing. There is no such thing as a bad note, but there is such a thing as buying notes badly. Okay, so due diligence is absolutely paramount to your note investing business. All right. We're going to talk about some case studies. Now, I will tell you that one of these I just recently sold. This property is a property in Casa Grande, Arizona. And I will tell you, everybody, that I have not updated slides. I've been so busy. So forgive me if you've seen this before. These are a couple notes that I bought a couple years ago. All right. So Casa Grande, Arizona, it's a duplex. We didn't know who was living in the property, but we knew that there were people in the property. We later found out they were tenants. Current market value of the securing collateral, that the duplex, was $120,000 to $125,000. We were all in for this note for $64,500. Again, property was occupied by unknown persons. We ended up having to take this property to foreclosure, and it actually came back to us as real estate owned, as REO. Now, my loss mitigation team, who are licensed debt collectors, they recommended that we evict the tenants, and I had another idea. I ended up sending out a door knock service, and we found out that these two families had lived there for many years, and they were paying rent to a property manager. So the door knocker got the property manager's name. We contacted that property manager, and she had been holding a couple months worth of rent because of the foreclosure auction. So we got that rent. We were able to collect that rent, right? And we told her we wanted to sell the property because we wanted to recapture our capital. So this was a pretty quick turn, everybody. It was less than a year. It was about 9 months for all of this to go down. The property manager, we said, hey, do you have an investor that looks for buy and hold properties, right? We sold it 21 days later, fully loaded, meaning we left the tenants where they were, for $120,000 in cash. After our closing costs, we had a profit of about $54,000 in change, which is approximately a 54% return on transaction. I use return on transaction, not ROI, because ROI signifies 12 months. Our JV partner on this one earned 27% in about 9 months, right? Who likes that deal? I do. All right. Now, this one, by the way, is a gorgeous old Victorian, 100 years old. Squatters had done some damage. At the time, the current market value of this property is $125,000. Now, because I am a reformed rehabber, I love Victorian properties. I looked up what the ARV was and found out it was about 225. All in for this note was 54,000 and change. The borrower was deceased, but the heirs would not give us a deed in lieu of foreclosure. All right. Now, the area was in the process of gentrification, but it had been rough. Literally across the street was a brand new rehab. And next door to this property and all down the street were multifamily apartments. And this property was also zoned R3. So someone could have torn this property down and built an apartment building. All right. Thankfully, they didn't do that. But squatters, again, had done some minor damage. We took this one to foreclosure auction, and the total amount of money owed was $217,000. Remember, everybody, the current market value was only $125. So we weren't going to see that $217. We set the opening bid a little lower than current market value because we wanted to create a bidding war, and that's exactly what happened. This sold at foreclosure auction for $124,000 and change. Now, Richmond, Virginia, by the way, is a non-judicial foreclosure state. This took 7 months. Our net profit was $70,000, which is 129% return on transaction. And our JV partners portion was 65%. Now, because again, I was a reform rehabber, I kept up with this, and about 4 months later, I took a look, and sure enough, that picture on the bottom is the picture that was on the Zillow listing. This house was rehabbed fully, and it was a minor rehab because there had already been some rehab done. That house sold for $230,000. So if you're a fix and flipper, and I don't suggest that in this market, but if you're a fix and flipper, then imagine if you had done that yourself, because you're into this for 50 grand, right? All right, last one, and then a couple little announcements. I'm going to do this super quick. My favorite exit strategy. This one is an owner-occupied single-family residence in Richmond, Kentucky. They had been squatting in their house literally for 6 years. The last payment they made was in 2012 when I bought it in 2018. I just sold this note. I'll tell you that in a second. All in for this note was $49,000 and change. The owner had been living there since 1998, raised their family there, right? Their legal collectible balance was $95,000, and their interest rate was 10.99%. Huge interest rate. These people were not bad people. Her husband had a medical condition and was out of work for 3 years, which is why they fell behind. We knew that they were going to want to stay in their home, and our team contacted them. Sure enough, that's what they wanted to do. In March of 2019, we put a trial payment plan in place for 6 months. They paid a small chunk of cash, $1,000 reinstatement fee. That's free money, by the way, everybody, because that went to the old loan, right? The borrower was successful in 6 months of TPP payments for $4,200. It converted to a permanent loan modification in 6 months later in October of 2019. What we did is we rolled some of that arrearage, meaning the default stuff, into the new UPB, right? And we gave them a little discount, even though they owed us $95,000 and they could have paid us off in full. By selling their house, we gave them a slight discount, and we gave them an 8% interest rate, which made their payment manageable for a 40-year term, 480 months, right? If you add all that stuff together, we're looking at a 25.5% cash on cash return for year one. Now, if you look at the amortization schedule, everybody, that shows and their monthly payment was $608.40. Of that $608, $580 every month was interest. That's pure profit to me, everybody, right? The borrower gets to keep their house, and we created a win-win situation. I literally just sold this note at the beginning of the year. So I cash flowed this thing for 4 years, right? At earning close to $580 a month in just interest. And I sold it for 100% of UPB. At that point, I mean, they had only, I think UPB was about $86,000. They had only paid down after 4 years. They had only paid down $1,500 in interest. So I cashed out at $86,000, right? Who likes to invest in real estate the way I do it, right? Creating win-wins, creating chunks of cash and streams of monthly cash flow. Now, if you're interested in investment opportunities, I do have a fund. I'm more than happy to talk to you about it. You can book your free call. You go to cashflowchick.com. There's a little button off to the side to schedule a free 30-minute consultation. I would love to talk to you if you want to learn how to do this, right? Because a lot of people want to know how to do this. And I used to teach workshops live and in person. I originally did 3 a year, then it went down to 2 a year, then it went down to 1 this year. I've now had created an on-demand training platform. So if you are interested in learning how to do this yourself, and I give you everything, there are actually a couple of my students on this call that I can see. I give you everything. I give you all of the tools, the workbooks, the analysis tools, my team. I give you everything you need to know to be a note investor. Okay. So if you're interested in that, go to cashflowchick.com/royal. And if you go there, you will get a discount. Now, normally my training was $697 to attend. It's 3 days. We've now broken it into modules, right? So $497, we're giving Scott and his crew and his people a $200 discount. You are some of the first to receive this exclusive launch program. So act now to get your $200 off. Again, go to cashflowchick.com/royal because I am not going to offer this discount for much longer. And you can go at your pace. All right. If you're interested in just some free stuff, please go to cashflowchick.com/free. Or you can go to /info and I'll send you a bunch of info. So there's videos and all kinds of stuff there as well. And then if you, again, want to reach out to me, connect with me on all the different social media platforms, you can email me at info@cashflowchick. Follow me, of course, on Facebook, YouTube, LinkedIn, and Twitter. Instagram is @thecashflowchick. And that's it. Let me turn on my video. There we go. And I'm happy to take some questions if you have any. Yeah, Liz was a part of my training. She actually came. Thank you very much, Liz, for that. Anybody have any questions? I don't see. Yeah, David. So 2023, I do agree with you. And 2023, we're going to start. We've just started tapping the surface. As of September of last year, we had a lot of foreclosure starts, and then it kind of stalled. But this last month, there have been reports that have come out, and Black Knight is one of the ones that I refer to, everybody. They do a monthly mortgage report. But Black Knight is reporting that we had a 371% increase last month in foreclosure starts, which is showing you where we're going with this market. I can't go in total depth about that, but starting 2023, we're really going to start seeing pricing come down. We're going to start seeing more inventory coming into the market. And so those of us that are positioned well are going to be able to take advantage of it. Yeah, so Black Knight has been actually they predicted, they were even talking in July about a couple of things that was going to happen, one of which was 2021. We're going to start seeing a lot of, that's why I say short sales are going to be starting to happen in 2024, probably not 2023, but 2024, because of all the people that bought homes at inflated prices in 2021 and 2022. So, yeah. All right, let me stop sharing my screen. Any other questions for anybody, from anybody? I hope you found that insightful. I hope you understand why angels sing for me when I talk about note investing, because it's just an amazing opportunity to, and there's many different ways. I mean, if you want to acquire property, please do so through notes, because you're going to get a discount to do it. However, It is no fun kicking people out of their house. So I tell my students, please, if you really want the house, please go after notes that are already vacant, right? The borrower has already left, because take it from me, it is not fun kicking people out of their house, right? All right. Doesn't look like I have any other questions. Oh, here we go. Wait. Katrina, are you connecting with REO departments at banks only, or are other financial institutions? And if so, Katrina, great question. So I actually, as the bank, I create the REO, right? So I'm the one that takes the property to foreclosure if I can't work out with the borrower to get them to start performing. So I actually create the REO. I'm the one in control of that. But to answer your question, in as much as I have networked with banks and hedge funds and asset managers, like in other note investors, I also have the opportunity to the back door to buy REO properties as well, because I've developed those relationships. So if that's your angle, you can do that as well. You're not going to get as big a discount as if you create the REO yourself by becoming a note investor. But there is that opportunity to buy REOs directly from the bank as well, as long as they're willing to sell one-offs. David, yes, David, I do have a fund that is opening. So if you're interested in talking about that, book a call with me. I'm happy to talk with you. I will tell you, December's coming and I'm taking a lot of December off to spend holidays with family. So don't be discouraged if you don't get an immediate call. You can also email me if it's urgent, right? But yeah, you can book a call directly on my calendar, and the fund will be opening in the coming year. It's done. My paperwork is finally done. I had a meeting yesterday. So yeah, if you're interested in investing, I'd love to talk with you about it. Liz said, can you explain what tapes are to those who may not be familiar? Thank you. Yeah. So a tape is an industry term. It is literally just an Excel spreadsheet that lists all the different assets that a bank or a hedge fund has for sale. And it has a variety of different information. It will give you some tapes are very, very thorough and give you a tremendous amount of information, meaning they'll give you the borrower's name. Of course, you're going to have the address. They'll give you the origination, the origination date, the original loan amount, original interest rate, original term, original P&I payment. They'll give you current, though all of those things, if the loan has already been modified, what the current UPB and interest rate and all of that stuff is. It will tell you when the borrower last paid. So, how current are they, or how delinquent are they? And then sometimes they'll give you what they call a 12-month look back period, which will show you 12 months worth of payments or non-payments, because sometimes borrowers will get a notice of default and they'll make a payment just to thinking that, oh, well, that's going to bring me current and it's going to stop the foreclosure action. And that's not in fact the case. So a tape is literally just an Excel spreadsheet that gets emailed to your inbox, that you look over and you analyze and do your due diligence to submit an offer to a bank. So, and all of that is done, everybody, via email. You don't have to go to foreclosure auctions and stand there and compete and bid. Yes, there is competition. Other note investors are very likely bidding on that same tape, right? So I teach you how to be a little competitive about that. And, again, it's just a gentler form of investing, period. Because your competition, you're not in these crazy bidding wars. And especially when you establish yourself as a note investor and you perform and you develop that relationship with that asset manager, oftentimes, as is the case with myself, asset managers are going to give me first crack at the tape. So I get to look at it first and get first choice. And then anything I don't want, then they'll sell, they'll present to some of their other investors. So there's tremendous opportunity when that happens, right? another question, why are they selling those notes for so cheap? Such a good question. All right. The simple answer is this. There's two reasons. There are many reasons, but these are the two primary. Federal deposit institutions like Chase, like Wells Fargo, have many different regulations and hoops they have to jump through to get to a foreclosure. And because they're a federal deposit, because they're insured by the FDIC, right? So depository institutions have more regulations than us note investors. As such, their cost to take a note to foreclosure is exponentially higher than it's going to cost us. So it oftentimes behooves the bank to take a haircut, discount the sale price, sell it to somebody like me, and then take the write-off for funds lost, right? They're going to take that write-off to offset their income. The second reason is that these federal institutions also have to have cash reserves. So when they loan $1 out, they have to set aside in cash other money that they can't touch, right? To keep their bank solvent and liquid. So when that note becomes non-performing, now not only are they not collecting money, they can't tap into that reserve account, that reserve cash. So once they sell it at that discount, now it frees up that cash so they can use it to lend it to somebody who will perform. Brenda asked, can anyone ask for the tape and put in an offer? Yes, Brenda, as long as you establish that relationship with that asset manager. And again, I buy from banks, hedge funds, credit unions, other note investors, note brokers. I lump them all under asset managers, right? So once you establish that relationship, and by the way, you don't pay for a tape, everybody, they're free, right? So don't ever pay for a tape. As long as you establish that relationship, and a lot of times these banks or hedge funds will have you sign a non-disclosure agreement, an NDA, right? And that's perfectly normal. So go ahead and sign that non-disclosure agreement, and then they will email you those tapes, all right? Yeah, absolutely. All right. Did I miss any questions that you see, Liz or Tammy?
I think David just put one more in
Okay, got it.
before we go.
The question above, is your opinion that the Fed will start selling their notes they purchase, causing a flood of discounted notes, or will they hold on? They're already starting. So yeah, David, they're already starting. I think that Fannie and Freddie are, they typically trickle things out. And you have to be a big player to buy those notes. The cool thing is, though, is that you're only about, as an individual, even new, you're only about 2, maybe 3 steps away from those banks that are big enough to buy those notes. And what I mean by that is Wells Fargo sometimes will buy those notes. We're talking hundreds of millions of dollars. But yes, I think that the Fed is going to start getting them off their balance sheet. All the GSEs are starting to get them off their balance sheet. The Fed is in a pickle right now because inflation is rampant. And the difference between now and the 1980s is that the federal debt in the 80s was only about 30% to the GDP, right? And I know I'm getting kind of high level here, but in the 80s, we were able to have those really high inflation rates because the banks could afford, the Fed could afford to pay the interest on the national debt. Now is completely different. So the Fed is in a pickle because we've got inflation that is really high. Anything that's above 8% in inflation, because our national debt to GDP is 120% in today's day, which means anything above 8%, our government cannot pay the interest attached to the national debt. And that causes a whole plethora of other big problems. So I think there's going to be some very big moves that are going to be happening in 2023, which is going to bring the note investing market into amazing opportunities. And by 2024, I think we're going to see a lot of what we saw in 2008. I do believe that. I don't know that pricing, I don't think it's like 2008, we fell off the cliff. I think it's going to be a slower progression now because we've, air quotes, learned, right? But I do think that we're going to start seeing a lot of that. Hope that helps.